Investing is like planting a seed for the future. You hope it grows into a strong tree that bears fruit, but there's always a chance it might not grow as planned. This is the essence of investment risk. It's the possibility that your investments might not perform as well as you hoped or even lose value. Every investment carries some degree of risk. Understanding this is crucial before you put your hard-earned money on the line. The level of risk varies depending on the type of investment. Think of it like choosing a mode of transportation. A bicycle ride is relatively low risk, while riding a motorcycle carries more risk. Similarly, some investments are like a leisurely bike ride, while others are more akin to a thrilling motorcycle adventure. The key is to find the right balance between risk and potential reward based on your financial goals and how much risk you're comfortable taking. Just as there are different types of terrain, there are different types of investment risks. Let's break down some of the common ones. Market risk. Imagine a sudden storm hitting the stock market. This is market risk. It's the risk that your investments will lose value due to factors that affect the overall market, like economic downturns, political instability, or even natural disasters. Inflation risk. Imagine a balloon slowly losing air. That's inflation risk. It's the risk that the purchasing power of your money will decrease over time due to rising prices. What you could buy for $10 today might cost you $12 in a few years. Interest rate risk. Imagine a seesaw going up and down. That's interest rate risk. It's the risk that the value of your investments, particularly bonds, will fluctuate as interest rates change. Credit risk. Imagine lending money to a friend who might not pay you back. That's credit risk. It's the risk that a borrower might default on their debt obligations, like a company failing to pay back its bondholders. Liquidity risk. Imagine trying to sell a house in a hurry. You might not get the best price if there aren't many buyers. That's liquidity risk. It's the risk that you might not be able to easily sell an investment when you need to, without accepting a lower price. Now that you have a better understanding of different risk types, let's look at some common investment products and their associated risks. Stocks. Stocks are like owning a tiny piece of a company. They offer the potential for high returns, but they also come with higher risk. The value of stocks can fluctuate significantly in the short term, and there's always the risk that a company could perform poorly or even go bankrupt. Bonds. Bonds are like lending money to a government or company. They generally offer lower returns than stocks but are considered less risky. However, bonds are still subject to interest rate risk and credit risk. Mutual funds. Imagine a basket filled with different fruits. That's a mutual fund. It's a collection of stocks, bonds, or other assets that are managed by a professional. Mutual funds offer diversification, which can help reduce risk, but they are still subject to market risk. Real estate can be a good investment, but it also comes with risks. Property values can fluctuate, and there are ongoing costs like property taxes, insurance, and maintenance. Real estate is also relatively illiquid, meaning it can be difficult to sell quickly. Section 4. Understanding your risk tolerance. Before you invest a single dollar, it's crucial to understand your risk tolerance. This means knowing how much risk you're comfortable taking with your money. Your risk tolerance is influenced by several factors, including your age, financial goals, time horizon, and personal comfort level with risk. For example, a young investor with a long time horizon might be more comfortable taking on more risk, while an older investor approaching retirement might prefer a more conservative approach. There are online questionnaires and tools available to help you assess your risk tolerance. Remember, there's no right or wrong answer. The most important thing is to be honest with yourself about how much risk you're comfortable taking. Section 5. When to embark on your investment journey. The best time to start investing was yesterday. The second best time is today. The power of compounding means that the earlier you start, the more time your money has to grow. Don't wait until you have a large sum of money saved up. Even small, regular investments can add up over time. The most important thing is to start investing as soon as possible and stay disciplined with your investments. Remember, investing is a marathon, not a sprint. There will be ups and downs along the way, but by understanding investment risks, diversifying your portfolio, and staying focused on your long-term goals, you can increase your chances of achieving financial success.